In mid-2024, a wave of panic swept across global financial markets. Headlines screamed that the 50-year-old petrodollar agreement had officially expired. Social media was filled with predictions of an immediate collapse of the US dollar. Many claimed Saudi Arabia was completely abandoning the greenback for oil sales. It sounded like the sudden end of American financial hegemony overnight. Viral videos showed graphs of hyperinflation and predicted a sudden collapse of global markets. For millions of retail investors, this was a terrifying wake-up call. They feared their cash savings would become worthless paper within weeks. Pundits urged viewers to sell bonds and buy physical gold immediately. It felt like a structural fracture in the world financial order. But in the world of global finance, narratives and reality are often different. As we navigate 2026, the global economy is indeed undergoing a shift. Saudi Arabia is diversifying its payment currencies and geopolitical alliances. Yet, the US dollar remains the cornerstone of global energy trade. So, is the petrodollar actually dead, or is this a gradual transition? To find the truth, we must look at the history and mechanics. We need to understand how the system was built and how it is changing. Let's trace the money from the deserts of Arabia to Washington. To understand the petrodollar, we must first look at the system that came before. In 1944, the international monetary system was established at Bretton Woods. The US dollar was pegged to gold at $35 per ounce. All other global currencies were pegged directly to the US dollar. This made the dollar the undisputed global reserve currency, backed by gold. But by the late 1960s, the system was under severe structural strain. The U.S. was spending heavily on the Vietnam War and domestic programs. Foreign nations began to doubt if the U.S. had enough gold to back its printed dollars. European central banks, led by France, began converting their dollar reserves to gold. They shipped tons of gold back across the Atlantic Ocean. This run on gold threatened to deplete U.S. gold reserves entirely. In response, President Richard Nixon closed the gold window in August 1971. The link between the dollar and gold was permanently broken. The dollar became a pure fiat currency, backed only by government promise. With gold backing gone, the U.S. dollar faced a massive crisis of confidence. Inflation surged, global stock markets tanked, and the dollar fell in value. A new anchor was needed to secure the dollar's global dominance. Without it, the American financial empire would have crumbled. That new anchor would not be gold, but black gold, oil. In 1973, the Yom Kippur War triggered a massive OPEC oil embargo. Oil prices quadrupled, pushing the U.S. economy into deep stagflation. Lines formed at American gas stations, and energy security became paramount. In 1974, Treasury Secretary William Simon was sent to Saudi Arabia. His mission was to secure a deal with the House of Saud. The terms of the secret agreement were highly strategic for both sides. The United States promised military protection, security guarantees, and high-tech weapons. They also agreed to protect the Saudi royal family from domestic and external threats. In exchange, Saudi Arabia agreed to price all its oil exports exclusively in U.S. dollars. No other currency would be accepted for Saudi crude oil. This created a global, non-discretionary demand for the greenback. Every country on Earth needed oil, which meant every country needed dollars. If Japan, Germany, or France wanted to purchase energy, they had to acquire dollars first. This effectively backed the U.S. dollar with Saudi oil. The petrodollar was born, replacing the gold standard as the global monetary anchor. It was one of the most brilliant financial maneuvers in history. This arrangement created a powerful closed-loop monetary cycle. This cycle is known to economists as petrodollar recycling. Foreign nations exported manufactured goods to the United States to earn dollars. They then used those dollars to purchase crude oil from Saudi Arabia. This left Saudi Arabia and OPEC with massive surpluses of U.S. cash. They could not simply sit on piles of paper notes. So, as part of the agreement, they reinvested those dollars. They bought billions of dollars in U.S. government treasury bonds. This funded the growing American national budget deficits at very low interest rates. The U.S. Treasury even created a special add-on window for the Saudis. This allowed them to buy treasuries directly, bypassing public auctions. It was a perfect financial loop for the United States. The U.S. could print currency to buy real, physical oil, and that printed currency would flow right back to purchase U.S. debt. This gave America an exorbitant privilege that no other nation possessed. It allowed the U.S. to run massive trade deficits without facing currency collapse. It also meant that the U.S. could export its inflation to other nations. For decades, this system seemed completely unbreakable. But structural changes in the energy markets began to emerge. The rise of new economic giants began to challenge the status quo. The real turning point for the petrodollar system occurred in early 2022. Following geopolitical conflicts, Western nations took an unprecedented step. They froze over $300 billion of Russia's central bank reserves. These reserves were held in correspondent accounts in Western financial institutions. For central banks around the world, this was a massive paradigm shift. It proved that sovereign reserves held in foreign assets are not risk-free. If you anger the host nation, your assets can disappear overnight. This weaponization of the dollar system created deep anxiety in neutral nations. Sovereign wealth funds in the Middle East and Asia began to reconsider their holdings. They realized that absolute reliance on the U.S. dollar was a strategic vulnerability. The quest for alternative payment networks and asset classes accelerated instantly. Countries began to diversify into physical gold, real assets, and other currencies. They wanted systems that lay completely outside U.S. legal jurisdiction. This search for alternatives is what paved the way for China's pivot. Today, the exclusive link between oil and the dollar is fraying. The biggest driver of this change is China, the world's largest oil importer. China buys roughly 15% of all global crude oil exports. Beijing wants to settle these trades in its own currency, the yuan. In recent years, Saudi Arabia and China have grown much closer. Saudi Arabia has agreed to accept yuan for some oil sales to China. Furthermore, Saudi Arabia joined Project mBridge in June 2024. mBridge is a multi-central bank digital currency platform led by the BS. It allows direct, instant cross-border payments without using the U.S. banking system. By bypassing SWIFT, countries can trade oil using local digital currencies. This makes economic sanctions by Western nations much less effective. It is a structural alternative to the traditional correspondent banking network. Furthermore, China is not the only player seeking. Russia, India, and other BRICS nations are building alternative payment systems. They are trading oil, gas, and coal in local currencies like rupees and rubles. The weaponization of the dollar system has accelerated this shift globally. Many non-aligned nations fear their reserves could be frozen in a political dispute. This fear is driving the development of parallel monetary systems. But accepting other currencies is not just a political statement. It fits into Saudi Arabia's long-term economic strategy. Saudi Arabia is currently undergoing a massive economic transformation. This strategy is guided by Vision 2030, led by Crown Prince Mohammed bin Salman. The goal is to diversify the kingdom's economy away from oil reliance. They are investing heavily in tourism, tech, defense, and green energy. To fund this, they rely on the Public Investment Fund, or PIF. The PIF manages over $900 billion in global assets. They need flexibility, which means holding assets in multiple currencies. Holding only U.S. dollars and treasuries is seen as a strategic risk. The freezing of Russia's foreign reserves by the West was a wake-up call. It showed that reserves held in Western banks can be seized overnight. Saudi Arabia wants to ensure its wealth is safe and diversified. They are building trade bridges with Asia, Europe, and Africa alike. They have even joined the BRICS alliance as an invited partner. This marks a major pivot toward a more neutral, multipolar stance. By aligning with both East and West, they maximize their leverage. But does this mean the U.S. dollar is losing its crown? The data suggest a much more nuanced picture. Despite the news headlines, the U.S. dollar remains dominant. According to the IMF, the dollar makes up about 58% of reserves. Its nearest competitor, the euro, holds only 20% of global reserves. The Chinese yuan accounts for less than 3% of global reserves. Furthermore, the U.S. dollar is used in nearly 90% of transactions. It is the world's primary invoicing and funding currency by far. The reason is simple: liquidity, trust, and deep financial markets. No other market offers the depth and safety of U.S. treasuries. If Saudi Arabia sells oil in yuan, they must hold yuan assets. But China has strict capital controls, making it hard to move money. It is difficult to reinvest billions of yuan safely and freely. Furthermore, global trade networks have powerful path dependency and inertia. Switching invoice systems requires massive changes in corporate legal contracts. Commercial transactions depend on the deep clearing infrastructure of the dollar. So while currency diversification is growing, the dollar's core remains solid. The petrodollar is not dead. It is simply sharing the stage. There is another massive pillar of dollar dominance that is rarely discussed. It is known as the Eurodollar market, a shadow banking system. Eurodollars are U.S. dollar-denominated deposits held in banks outside the United States. This market began in the 1950s and has grown to tens of trillions of dollars. It operates completely outside the direct control of the Federal Reserve. International corporations and foreign banks rely on this market for liquidity. They borrow and lend in offshore dollars to fund global commerce. The sheer scale of this offshore dollar market dwarfs the oil trade itself. It creates a massive, self-reinforcing network effect for the dollar. If a foreign bank wants to switch to yuan, they must build a similar network. They would need deep, unregulated offshore yuan markets that do not exist. Without this shadow backing, no currency can easily displace the dollar. The Eurodollar system acts as a fortress protecting the U.S. currency. It makes any sudden collapse of the dollar highly improbable. So, what does this new multipolar world mean for the future? The primary consequence is a gradual decline in U.S. debt demand. If OPEC nations buy fewer U.S. treasuries, yields must rise to attract buyers. This means the U.S. government will face higher borrowing costs on its debt. It could put pressure on the federal budget, leading to higher taxes or cuts. It also means the U.S. cannot rely as easily on printing money. We are moving away from a unipolar financial system toward a fragmented one. This fragmentation will take years, if not decades, to fully play out. The dollar is not collapsing, but its exclusive privileges are shrinking. This will lead to more volatile exchange rates and higher global inflation. The cost of funding global trade will slowly increase for everyone. U.S. consumers may face higher prices for imported goods over time. The era of easy deficit financing is slowly drawing to a close. Smart investors should watch these structural flows, not the sensational headlines. The petrodollar shift is a slow transition, not a sudden crash. The global financial system is evolving, and diversification is the new norm. Understanding these structural changes is key to navigating the future of money. Please remember that this video is for educational and analytical purposes only. It does not constitute financial or investment advice of any kind. Always do your own research and consult with a professional advisor. No single currency will destroy the dollar, but a multipolar trade system is here. If you found this analysis helpful, please like, subscribe, and share. Thank you for watching Chronicle, and we will see you next time.